Less than an hour ago, the Bureau of Labor Statistics revealed that wholesale prices rose by 3% on a year-over-year basis. That was higher than the 2.7% economists anticipated. Meanwhile, the U.S. Consensus Bureau disclosed that November retail sales rose by 0.6% month on month, a tick higher than the 0.5% that economists forecasted. Joining me now with more is Mark Zandi. He's chief economist at Moody's Analytics. Mark, it's great to have you on the show this morning. And let's start with the economic data that we got earlier in the 8 a.m. hour. What is your take on these reports?
Well, retail sales not bad. They're pretty good. That's November's data, so the start of the key holiday shopping season. So pretty good. Year over year, feels like we're seeing growth on a real basis after inflation of about 1 to 2%, which for retail sales is pretty solid. So the consumer is hanging in there, at least through the month of November, and that's a very positive development. Obviously, inflation is on the high side of where we'd like it, and you can see that with the producer prices. So, all in all, I think the numbers are very close to expectations, indicating that the consumer, the economy are hanging tough, but inflation remains a bit of an issue.
We are going to hear today throughout the session from about a half of a dozen Federal Reserve officials who are on the schedule to speak. Of course, the Fed's independence very much in focus, as well as the path forward for borrowing costs. What do you anticipate to hear from them?
Well, I don't know that they'll be talking about Fed independence. I mean, there's a lot to talk about with regard to the outlook and their dual mandate and what's the appropriate stance of monetary policy. A lot of debate, reasonable debate around that. So I suspect that they'll stick to that script and not venture into the debate or discussion or concerns around Fed independence. But there are real concerns. I think it's clear to everyone that a cornerstone of a well-functioning economy, a market economy like our own, is an independent Federal Reserve central bank. We know this from history here in the U.S. and overseas, and we really don't want to go down the path where the Fed's independence is impaired. And clearly, that's a real risk here. So, this is a very significant issue, but I suspect that the Fed presidents probably won't go down that path, at least not today.
With the inflation data out this morning, Mark, and what we know about the jobs market, how does that impact the Fed's decision on borrowing costs? The next meeting that we'll get and decision from the Fed, of course, comes at the end of January.
Well, as you know, Kristen, the Fed's been put in a pretty tough spot because of the tariffs and immigration policy. Those policies weigh on economic growth, and all else equal, that would suggest that the Fed should cut rates. But it also adds to inflation, which means the Fed, all else equal, should raise rates. So what do? I think they've decided that the mandate around full employment is probably more important in the current context. And also, given that the inflation feels like that should be more temporary, given that it is the result of one-off increases in tariffs. But I expect that to continue. I think the next move will be a cut. I think it's just a question of when. My sense is that the labor market is very soft. We're not creating any jobs, and that's even pre-revision. After revision, there probably shows some declines. Unemployment is rising. It's headed north. And given that, I think that's going to be their paramount kind of focus. And that argues for a rate cut. I suspect March. I don't know that I debate anyone very strongly if they said June or July. And that's the other thing. In June, we get a new Fed chair. Presumably, we get a new Fed chair, and that person will be more predisposed for lower rates. So I think we'll get rate cuts at least by then.
Mm-hmm. I do want to talk to you about U.S. tariffs and the data that you've seen on that front, because as soon as today, we could see a ruling by the Supreme Court on the validity of U.S. tariffs.
Yeah, and that, in my view, would be a very positive development. I think if the Supreme Court ruled that the so-called reciprocal tariffs that were imposed back on Liberation Day in April of last year were unconstitutional, done under an inappropriate legal kind of justification, and required that they be dropped. If the president does not respond to that by imposing other forms of tariffs, which is we'll have to see, but I suspect he might not, then that would cut the effective tariff rate in half. Right now, the effective tariff rate if you look across all products and all countries, is just over 10%. And if the Supreme Court ruled favorably here, they would cut those tariffs in half, and that would go a long way to helping support economic growth and reining in inflation. So I view that as a very positive development if that were to occur, and hopefully it does.
Mark, we are exactly 2 weeks into the start of 2026. It's January 14th. What is your outlook for the year?
Should be okay, Kristen. I think there's headwinds and tailwinds like there always are. The headwinds are tariffs and immigration and deglobalization. Just generally, the U.S. economy is pulling away quickly from the rest of the world. The world's pulling away from us. That's bad for growth. That's bad for the economy. That's a headwind. But fortunately, we have the tailwind of artificial intelligence, all the investment spending, and of course the wealth effects. I mean, the stock market, as you know better than me, is up an awful lot, generating a lot of wealth. And so the well-to-do are in a pretty good financial spot. And that's why we're getting those pretty solid consumer spending retail sales numbers, is because high-end consumers, have a lot of wherewithal to spend. That should drive growth. The other thing that will support growth, at least temporarily, particularly in the first half of 2026, are tax cuts to businesses through expensing of investment. Individuals' refund checks are going to be large this year, and that should support spending by middle-income households. So I suspect we should have a pretty good year. But when you're not creating any jobs, and we're not, and I don't expect we're going to create many, even under the scenario I just kind of laid out for you. That's a pretty fragile place to be. And if anything doesn't stick to script and we start to see some layoffs kick in for whatever reason, I think the economy is going to have a much more difficult year. So should be okay. That's the most likely scenario, but a lot of risk to the downside here.
Mark Zandi, chief economist at Moody's Analytics, joining us this morning from Florida. Mark, thanks again.
Anytime. Take care now.